Entering a trade, part 1. So when should we enter? Right? This is where things get a little more flexible as to how you want to move in and out of the markets. My goal was always to extract as much from the markets as possible, so that is the vantage point I will approach this from, because I believe that's probably what most of us are here for. But hopefully in doing that, it will open you up to your own preferred ways to approach managing your trades. I will also try to give multiple examples in case ideas do not come to you easily, but this is where dedication to staring at and studying charts comes full circle. Just staring at a blank chart long enough should have your wheels turning about how you might buy and sell within the price action. And if you've got a little bit of experience, then generally you already have an idea of what kind of price action you're drawn towards. And kind of like where you see opportunity. And even though that changes over time, I feel like we've done a pretty thorough job of running through, different types of trends and type of markets and environments that you should have an idea of where you're drawn to and what you're drawn to, and maybe you're just following along, and that's fine as well. Because again, I think that there's, even though, and we're going to go over that in the future, right? That there's a million, like they say, there's a million ways to make money in the markets, but honestly, there are fundamental truths that just don't change and are true for everybody, that everybody must follow. So things like trends, uptrends, downtrends, rotational markets, reversion to the mean. Those things are things that don't change. They're like solid truths in the market that it doesn't matter your opinion, those things are going to happen. They're just naturally occurring consequences of what people in markets experience and do, right? So when you cut your piece of the pie and you figure out your strategy, it's still based around those fundamental truths, right? So back up here, now that I've interrupted the process, so I'll just go ahead and reread that again, right? Staring at a blank chart long enough should have your wheels turning about how you might buy and sell within the price action. So those are the rabbit trails that you should follow, right? When you see something that interests you, when you see something where you think you see opportunity, that's where you should allow your mind to wander through the potential trade scenarios, and that will give you precious insight as to how your brain is wired, and following your natural interests through the charts not only develops your intuition, but will help you see opportunity and then test ideas that mold how you trade. Then you apply the principles you've learned here, and then you hit the ground running. All right, entering a trade. Once we have created our game plan for whatever time frame we are trading, we should have a good idea of where we want to enter based on our preconceived idea of which direction we want to focus on through trade preparation. If we think prices are going higher, ideally we want to enter on a pullback of some sort to a support area, or maybe a break higher from a consolidation pattern. Remember, context matters, and we want to make sure that the initial risk-reward makes it worthwhile. If there is a large area or level of resistance just above where it makes sense to buy, we need to know that, right? And we need to be aware of the potential effect it might have. So maybe we want to break our trade up into multiple legs in order to snag a partial profit there in case things reverse, right? But if you trade full size and you go up into that resistance level that's just above your trade, that's essentially almost potentially setting your trade up for failure, and you don't even know that it's there, then what happens? It was a trade that you didn't plan properly for. If the trade reversed, it ends up becoming a loss, and you didn't even realize that there was a specific market force that was kind of already setting you up to be in a negative position if you weren't taking a profit there, or at least not aware of the fact that it might reverse there, or the importance of it breaking through that level. Again, you're because you've missed out on something that was so obvious but you didn't know to look for prior to taking this course. Again, that's another negative strike against your psyche and against your account, right? That's why all this is so important. Most of the time, you will not have an immediate trade, as soon as you sit down and start looking at the charts, right? And you will begin to watch price action develop and wait for an ideal entry opportunity. And I call this stalking a trade. So patience is the name of the game to get an ideal entry, as most rush entries are not in an ideal location, and therefore the profit potential will be limited. Right? So same thing with, whether it's your day trading and you're sitting down at your computer in the mornings, or if you're swing trading, right? You come in, you're sitting down, whether you're doing like your kind of like nightly chart review or during the day, and you're going through your list of of assets that you're potentially wanting to trade, waiting for something to develop. So you get you do your review, you get in sync with that specific market. You see exactly where it's at, you feel where it's at and where it's likely to go or what it's going to do. And then you set up triggers to watch what's happening, right? So if you expect it, if you're waiting for a trigger to essentially get involved in the market, let's say the market's just consolidating, it's not really going anywhere, and you see the support and resistance levels that are obvious, you can just set up a trigger in your phone that says the market broke out, to the upside or to the downside at a certain price level, and boom, for that asset, you just set that up automatically. Be like, this is what I want to see. Or let's say we expect it to go up and we're looking to get an entry lower to the bottom of that consolidation area. You set your entry trigger, or not your entry trigger. You can set an entry trigger, but you can set just a price alert that just lets you know, hey, price is moving. It's doing what you wanted it to do. It's giving you your ideal location. It's time for you to take action. And now, as a swing trader, that's like one of the joys of that, is that you don't have to constantly be watching the markets. You can let something else alert you to the fact of what's going on.